Um, Hello, everyone. Thank you for joining us tonight for Investing 101, Part 2, Cryptocurrency. My name is Shanika McIntosh. I am the Director of Programming for Spark of Hudson. The Spark of Hudson is a innovative learning hub based in Hudson, New York. Our programming mission is simple. Everybody has something to share, and with that ethos, we aim to amplify and create new opportunities for community growth and equity with an emphasis on partnerships and collaborations. We have a lot of upcoming programming and virtual programs that we've done in the past, and I encourage everyone to visit our website, sparkofhudson.org, or to follow us online on Instagram, Twitter, Facebook, at Spark of Hudson for updates on upcoming programs and other community initiatives that we're involved in. Also, we encourage feedback and participation from the community. So if you have a program you'd like to host or a program you'd like to happen via the Spark of Hudson platform, you can reach out to me, Shanika, at sparkofhudson.org. Tonight, we will be picking up part 2 of a new series, Investing 101, led by Albert Wenger. Albert Wenger is a managing partner of Union Square Ventures with its own dedicated climate fund. He's also the co-founder of the Spark of Hudson and Wally Farms. I leave it to you, Albert. Thank you.
Thank you, Shanika, and welcome everybody to Investing 101 Crypto Edition. So I'm going to just kick this off by saying that providing an upfront warning, as it were. Crypto is really highly speculative, and you should, under no circumstances, invest more money than you can afford to lose entirely. And you should also be prepared for a wild ride. In the last couple of weeks alone, crypto has corrected, depending on which part of it, by 30, 50, 70+% down. So whatever amount of money you should have in there should be an amount of money where, when that happens, you're not going to lose sleep. And I should also add the sort of time where people got fabulously wealthy on crypto, you know, where they put $1,000 in and wound up with $1 million. Those times are actually likely over. So with all these caveats, you might say, well, why bother? Like, why should this be interesting? And I think some historical context really helps here. So people started trading commodities in the Sumerian Empire 4,000 years ago. People have been trading and investing in rare metals for 3,000 years. Modern equities, the little slip on the right is a stock certificate for the East India Company. Modern equities are 400+ years old. Bonds about the same. And so pretty much all the type of investments that people make are really quite old and really well established, and there's a lot of knowledge around how to invest in them, and there are a lot of markets that are very efficient. But crypto is really, really new. As of this moment, it's a dozen years or so old. So that's why people really should learn about this now, because it's an opportunity to still get into something when it's really quite young. And so what are our goals for today? Our goals are, number one, to provide an overview of crypto. And that overview is really about, you know, just understanding why does this thing exist? What is it at its heart? Why does it matter? The second goal for today is to provide an introduction to common terms that you will run across in your own research into this. And the third goal for today is to actually get you all started on investing, at least in a very minimal fashion. So those are the three goals. Now, I want to start by talking about money for a moment. And on the right-hand side, you have a picture of some Roman coins. And the reason I want to start there is because it helps us think about two specific problems. So one is, when you want to have money, you want to have a controlled money supply. You don't want anybody to be able to create new money, because then the money would be instantly worthless. And that's really historically happened through two ways. One is to use rare materials. Metals were rare, quite rare at one point. and also through having some kind of right of coinage. So usually the king or ruler had the right to make new coins, and often would put their own likeness on said coin. So that kind of solved the problem. People couldn't simply easily make new coins, and if they tried to do it, they would use it with very heavy penalties. And so that controlled the supply of coins. Now, the second thing that makes physical coins interesting is that it's very clear who has the coin. Like if I have a coin and I hand it to you, you now have the coin and I no longer have it. So I can only spend it once. Once I've given it to you, now you can spend it, but I can't spend it again. And that's very easy to do when you have a physical token, essentially. Now, obviously, we live in a digital age. And so one of the questions is, how can we have digital money? How would that work? And so when you want to have digital money, you need to be able to answer these same questions. How do we control the money supply? How many coins are there? And who gets to make new ones? And how do new ones come into existence? And then we have to answer the second question. When I give you one of my digital coins, how do I make sure that you have it and I no longer have it so that I can't spend it yet again, something that's known as the double spending problem. So these are the two central questions: the supply of coins and how to make sure that coins can only get spent once. And we have a solution for that, a very well-known solution, multiple well-known solutions, and they're all centralized. And obviously one that grew up with the internet, that provided a lot of the early payments on eBay, for example, is PayPal. And many people around the world have PayPal accounts. And so how does PayPal solve these two problems? Well, PayPal is based on fiat currency. So they only use currency that's been created by governments. So it's the governments that control the money supply. So PayPal itself doesn't change anything at all about the money supply. And then how does PayPal solve the double spend problem? Well, they keep all the balances on their servers. So if I send some money from my PayPal account to somebody else's PayPal account, PayPal will deduct it from my account and add it to the other person's account. And that takes care of the double spend problem. So you might be like, great, why, this is a solved problem. Well, it's not, because there are clear issues with this. So one is the dependency on fiat currency. So if you happen to believe, as many people do, that governments are printing too much money, then the fact that PayPal doesn't control the money supply becomes a problem, because PayPal's money supply is the same money supply as those of the fiat currencies. And then the second problem with centralized players like PayPal is that they can cut people off from their money, and they actually do that. And so just to give one example, if you make money on a platform and maybe the platform disagrees with the product you've sold, they're like, oh, that's not a legal product, or it violates some morality that somebody has an issue with, you may not be able to collect your money. And so that's a problem. And that's going to be a bigger problem to the extent that governments become less democratic. The ability to control people's money becomes a problem, whereas cash, traditional cash, is something that people can give to each other without government easily being able to interfere. So there are real issues with centralized solutions. And because there are real issues with centralized solutions, people have been searching for decentralized digital money. And so let's just start with a really naive approach to this. So really naive approach is, I'm going to start a text file on my computer, and I'm going to put some balances in there. And I'm going to start changing my text file to reflect payments, and I'm going to send it around by email. And, I make some payments, let's say to Shanikia and to Susan, and I record them in this text file. And then I send the text file to Shanikia and Susan. Now, a very obvious problem arises in this naive system, which is they're going to start to make changes to the text document itself. And so now all of a sudden there'll be 3 versions, and that's just with 3 people. And anybody who's ever worked on a project historically where you've sent files around has seen this problem. Let's say you have an Excel spreadsheet and you send it to a colleague, and the colleague makes some changes, and now you get on a phone call and you can't agree why the results are different. And so this problem, this naive approach, simply doesn't work. We can't let anybody make any change they want to. And again, for spreadsheets, for presentations, for Word documents, we have now, again, changed this by basically having centralized services, right? People use Google Sheets, people use Microsoft Office in the cloud. And when you do that, there is a central service, and the central service tells you what the current version of the file is. So this was an unsolved problem. Nobody knew how to do this in a decentralized fashion until a moment in 2008. And that moment was when somebody published a white paper about a new system called Bitcoin. And this was authored by somebody named Satoshi Nakamoto. Nobody knows who he, she, they are. And they proposed a new system. And I will talk in some detail about the system in a second. They didn't invent anything fundamentally new. They took two existing technologies that had existed separately and they put them together in a really innovative way. And that made Bitcoin possible. The system launched in January of 2009. I listed some random highlights. As late as 2011, 2 years after the launch of the system, a Bitcoin was 30 cents. 2011, 2013, it was infamously used a lot for Silk Road. Some fantastic books and also movies coming out about the Silk Road story. 2014, for people who were in crypto at the time, was the infamous Mt. Gox bankruptcy. Mt. Gox was the first big exchanges where a lot of people bought and sold Bitcoin. 2018, China decided to ban all Bitcoin trading. 2021, El Salvador did the opposite. They made Bitcoin legal tender. I'm giving these highlights in part to illustrate that Bitcoin has been through many different big events, both up and down events, and it's just kept chugging away. Literally since January of 2009, this chain has been operating 24/7, creating new entries into the chain. And completely uninterrupted by many people leaving, many people joining, different servers leaving, different servers joining. It's an incredibly extraordinary accomplishment to have such a resilient system. We all know that we go to work and we fire up the computer and we try to access some service and it's down because Amazon is down or Cloudflare is down or Google is down or some other thing is not working. This thing's just been chugging away. It's quite truly, truly extraordinary. Okay, I'm going to talk very briefly about how this works. Doing this just so you get a sense, an idea for how something extraordinary like this might work. And so the idea is really quite simple. If you want to make a payment on Bitcoin, you say, I want to send, here I'm giving the example, 0.05 Bitcoin from this address to this other address, and I'm willing to pay this fee. And these announcements of transactions can just be broadcast onto the Bitcoin network. And now people who operate mining nodes, what they can do is they can gather up a bunch of these transactions and propose a new block. Now, in order to avoid this problem that I was describing earlier, where each of us are changing our text documents on our own, we need to have some method so that not too many people are going to propose a new block at once. And the method for that is to have people solve a puzzle. Now, you can think of this like Wordle. Like Wordle is hard to solve, but once I've solved Wordle, I can show somebody else that I've solved it, and they can instantly basically verify that I've actually solved it. And so in Bitcoin, there's a similar problem. It's very hard to solve. Takes a whole lot of just crunching around. But when I've solved it, I can show to others, yeah, look, I've solved the problem. And so if I want to be able to propose a new block, I have to solve this puzzle. And because very few people solve the puzzle at any time, there are very few, usually only one proposal for a new block. And in this block, I can only include valid transactions. Now, what makes a valid transaction? Well, first of all, the address needs to have enough of a balance to be able to spend it. So if I have 0.5 Bitcoin, I can't be spending 1 Bitcoin. And then there can't be any duplicate spending transactions in the same block. So if I have 0.5 Bitcoin, I can spend 0.5 and 0.5 and 0.5 again, which would be 1.5 Bitcoin. I can only spend 0.5 Bitcoin in that block. And every transaction has to be signed by the owner of the sending address. By signed, I mean a digital signature. I'm not going to explain how digital signatures work, other than to say that in order to sign a digital transaction, you need to have some private information, a so-called private key. And only you can have that key, because if somebody else had the key, they could be signing transactions for you. So you must guard this key. And conversely, we'll come back to this several times throughout this. If you lose this key, you can no longer sign transactions, and it means you can no longer spend your Bitcoin. Your Bitcoin is lost forever. Okay, so this process of gathering up transactions, valid transactions, into a block, solving the puzzle, announcing the block, that process is known as mining. And it's in that process that new Bitcoin come into existence. Because when you have successfully found a new block, you earn some freshly minted Bitcoin. You also, by the way, get to collect all the transaction fees of all the transactions that are included in your block. So this is the system. And because the number of new Bitcoin that you get when you successfully mine a block, because that declines over time, that's why the total supply of Bitcoin is limited to 21 million coins ever. Now, that could change if everybody who mines Bitcoin, if the vast majority, more than 50% of all the people who mine Bitcoin were to agree to change it, only then could this change. Okay. Why is it called a blockchain? Well, I mentioned that when you solve the puzzle, you announce a new block. The block contains a link to the prior block. And those links go all the way back to the Genesis block that was mined in January of 2009 by Satoshi Nakamoto. That's why we call these things blockchains. Each block contains a bunch of transactions and links to the prior block all the way back to the Genesis block. Now, you may have heard the word smart contracts. And again, I'm not going to provide a lot of detail. The goal of this is to provide an overview. But you can think of smart contracts like macros in Excel. When you have a macro in Excel, you can make additional things happen when, let's say, a value is entered into a cell. You might kick off a more complex process where you calculate taxes, for example. So the smart contracts are pieces of code that execute when transactions happen in a blockchain. I give a very simple example here. By the way, the code on the side is just some sample code, so you get some idea of what these things look like. But like an example of a very simple smart contract might be when an amount arrives at a certain address, it gets automatically split into 3 or 4 amounts and sent to other addresses. And you could see how that might be useful in bill splitting among roommates, for example. The ability to create these kind of smart contracts is very limited in Bitcoin, but it's very powerful in Ethereum, as well as in other chains like Algorand, Solana, and many others. I'm going to point something out. I will have some stars in this presentation. Each time there's a star on some project, it means that Union Square Ventures, the firm where I'm a partner, has some exposure or is an investor in this. So I'm going to mention this once, but you'll see it throughout. There are projects such as the Stacks project that are creating powerful smart contracts also for Bitcoin. So Bitcoin isn't entirely limited in the way people sometimes describe it. Now, why does crypto matter? I mean, this is all very interesting. Decentralized currency. I kind of explained a little bit what some of the problems with PayPal are, but people might be like, oh, those problems strike me as not that important. This seems sort of like a minor thing. Well, let's talk a little bit about the web. And the friendly gent on the left here is now Sir Tim Berners-Lee, who invented the web about 30 years ago. At the time, he published this thing called the HTTP specification, which all the web runs on. So when you go to a website, it runs on this protocol. And then Netscape browser was released, Internet Explorer was released a couple of years later. And what HTTP made possible was this idea of permissionless publishing. Anybody could put up a website and anybody could access a website. And the result was this extraordinary explosion in websites. People had personal websites. Every lab at a university had its own website. And it felt like, oh my God, we have entered this permissionless world. There are no gatekeepers. Everything will be decentralized. Well, fast forward, and we're finding ourselves in this world that's heavily dominated by the Facebooks, the Amazons, the eBays, the Twitters of the world. And we're like, how did that happen? Well, the HTTP protocol, one of the reasons why it was really, really easy to implement is because it's a stateless protocol. It has no sense of history, no sense of data. And so it made certain things that people wanted to do that should be easy, it made them quite hard. And the canonical example I give is a shopping cart. Like when you put one item in the shopping cart and you come back, you want to put a second item, you want the first item to still be in the shopping cart. Otherwise, it's a pretty useless shopping cart. And the early solution to this problem was the invention of the cookie. The cookie was actually invented by Mark Andreessen and the team at Netscape. And the cookie are these little files that your computer sends back and forth when you browse the web. And you can put information in the cookie. And the early implementations of the shopping cart were literally that the items in the shopping cart would be put in the cookie and come back to your computer. And then you would send it back and you put an extra item in, and now there'd be 2 items in and so forth. Now, in the modern implementations, all that the cookies tend to contain is your user ID. So when you come back to Netflix, Netflix is like, hey, who's watching? One of these people. Oh, I recognize this computer. When you come back to Amazon, you're already logged into Amazon. And that's because the cookie contains who you are. Everything else is being maintained on the server. So when you put things into your shopping basket now, the shopping basket, the shopping cart is actually maintained over on the server. And this turned out to be the centralizing force of the internet. And today, all the big giants of the internet, they're really at the heart, they're gigantic databases. Now, I already gave the example of PayPal, right? So PayPal maintains your account balances. It runs the database for your account balances, for everybody's account balances who is on PayPal. But if you think about Amazon, what is Amazon at its heart? At its heart, it's this database of SKUs, items, payment credentials, and people's purchase histories. People often say, well, but Amazon also operates a lot of warehouses and a lot of trucks. Well, yes, so does FedEx, but have you looked at which is the more valuable company? Amazon is way more valuable because it owns the database. FedEx just carries out the shipments. It doesn't actually own any of the matchmaking capabilities that are made possible by the data that Amazon owns. Think about Facebook or Twitter. They have profiles, friend or follow lists, and status updates. And even Google at its heart, it's a database. It's a database of knowing what the pages on the web are and what people's search histories are, so that when I type Apple, when I do a lot of work researching Apple, I get different results than you when you're researching Apple because you have an orchard. And Google has that database. And because they know what these relevant terms mean for different people, they can surface better search results. So at the heart, the internet giants are databases. And now you can start to see crypto in a different light. The web was permissionless publishing, but it had no notion of data. What crypto provides are permissionless databases, databases that anybody can interact with. And so the beauty here is that you get these network effects. Network effects means as other people use Amazon becomes smarter, it can propose, for example, related products. Well, only Amazon can do this because only Amazon has the database. But that's an important network effect. But here we can have this network effect without a company being in charge. And not having a company in charge means there's no value extraction. The network effect is effectively owned by everybody who participates in the network. So instead of value being extracted out to a corporation, value is shared among the people who participate in the network. And then we can also have this amazing thing. I mentioned smart contracts earlier. We can also compose smart contracts in a permissionless fashion. So if somebody's created some piece of functionality on top of that code, on top of that data, so let's say the split payment example I gave earlier. Well, if you created a smart contract that basically waited until a certain amount was there before releasing it, you can sort of see how you can combine those two to create something that's like similar to Kickstarter, for example. And so this is a completely new piece of infrastructure. It is permissionless data, and it's a foundational revolution in how we can build things. And so then the question is, well, what are people building? And people are building everything. People are building decentralized versions of Patreon, of Tumblr, of stock exchanges, of identity, even of basic income, and so much more. There are thousands and thousands of exciting projects being built. They're all small for the most part. They're all early, but they're being built and they're being used. And they're real. They're not some made up thing. Like sometimes people will criticize crypto and say it's just some gigantic Ponzi scheme. And those people don't seem to be aware of this extraordinary activity of new systems being created. And are they going to replace Amazon or Facebook overnight? Absolutely not. But are they creating interesting new alternatives that have new capabilities, new features, different nexus of control? 100%. And the little boodle on the right here is actually the icon of a such system called Gitcoin that helps fund a lot of open source development. And this is a little meme in crypto. We often, when there's a D and an L, will reverse them. This harkens back to some typo that somebody made, but it's become a meme within crypto, and it's kind of funny. Now, with all this as background, okay, so this background is supposed to tell you this is in fact a meaningful innovation, and people are building on top of this meaningful innovation. Well, with this background, how do you get started investing? And I've tried a couple different things, and the easiest, if you have zero exposure to crypto today, the easiest way to do it, or one of the easiest ways, is to download the Cash app that's made by Square. You link your debit card, and then there's literally a button where you can buy Bitcoin, and the smallest is $5 worth of Bitcoin. And I tried this out last night, and I was able to complete it all in less than 10 minutes. And when you do that, you are now an investor in crypto. And again, the little inversion of the L and D. So hodling is just holding crypto. You're now a owner of crypto if you do this. And I would encourage everybody on this to go through this because it will sort of demystify things pretty substantially for you. Now, let's say you don't actually want to sign up with an account, you don't want to link a debit card, but you still want to play around with this. Well, an alternative is you can download a wallet. For example, Coinbase wallet. We'll mention some more wallets in just a second. You can download one of them, and then you just email us, or you submit, I think Shanika will publish a form, you submit via the form, the Bitcoin address at which you want to receive Bitcoin, and we will send you a very, very, very small amount of Bitcoin. By the way, just to give you some idea, Bitcoin is subdividable to 10 to the 8th power. So that smallest unit is known as a Satoshi. So we can send very, very small amounts that way to people, but at least you have some, and you have some initial exposure to it. Okay, so that's how you get started. Before we continue, let me remind you again, crypto is incredibly volatile. This is the price history of Bitcoin, basically almost back to inception, not quite. The first thing to point out here is that for the longest time, Bitcoin was basically sub $100 or at $100. Then there was the famous first crypto bubble of 2017 when it spiked to nearly $20,000. Then it came back down to $3,000. So $20,000 down to $3,000 is like an 80+% reduction in value. And so then you can see the more recent volatility, you know, running up to 60, coming down to 30, running up to near 70, coming down to 30. There's no reason to believe that this will become less volatile any day soon. And also, it can go to zero. Now, I should be clear, stocks can go to zero too. Companies sometimes go bankrupt. When a company goes bankrupt, the stock goes to zero. So let me repeat what I've said throughout Investing 101. In all of those things, your exposure should be such that if the thing were to go to zero, you would not be in some deep, deep, deep trouble. Like you would, your life wouldn't be financially over. You wouldn't be bankrupt. You wouldn't be. So people make this mistake all the time. They see something and then they use leverage. They use debt to go buy something. If you use debt to buy something that goes to zero, you still owe that money back. And that's an easy way to go broke. So with all investing, and especially with things that are volatile and with things that can go to zero, you want to use small amounts of money that you can afford to lose if the worst were to happen. Okay, we're going to cover a whole bunch of important terms. So one of the terms you'll hear a lot of wallets. Now, a wallet is exactly what you would think. We all usually walk around with wallets that have credit cards and cash in them. And a crypto wallet is a wallet that holds crypto. The icon on this logo on the right is the MetaMask logo. MetaMask is a browser plugin. It is the most widely used wallet on the web. But there's many mobile wallets, and increasingly websites can also link to mobile wallets. And I'm just giving the names of some of them: Trust Wallet, Konomi, the Coinbase Wallet, Cash App, and so forth. Now, if once you have more serious amounts of crypto, you definitely want to keep these with a custodian. And those are companies like Coinbase, Gemini, Binance, Robinhood, or you want to keep them on a hardware wallet. To understand that distinction, let me explain the difference between custodial on crypto and self-custody. And it's a really simple distinction because we are very familiar with it from regular money. Custodial is like keeping money at the bank. And so if you keep your crypto with places like Coinbase, Gemini, Robinhood, Square, etc., they are storing that famous private key for you. Okay, so remember when I said if you lose the private key, you can no longer sign transactions? Well, in the custodial example, those custodians hold the keys for you. And it comes with exactly the same advantages and disadvantages of keeping money at the bank. When you keep money at the bank, let's say the bank itself doesn't open because it's the weekend, you may not be able to get to your cash. If you think about the early days of banking, the Wild West, banks got robbed all the time and there was no FDIC insurance and your money was literally gone when the bank got robbed, right? Or the government goes to the bank and says, don't give this person their money. I have a claim to this money. So custodial has advantages in terms of you don't need to remember where you put your private key. Your private key can't get hacked, presumably because these folks take very great care not to get hacked. But you've given up a large degree of control. Conversely, self-custody of crypto is like keeping money in the mattress. You have access to it, but if you accidentally throw out your mattress and the garbage truck takes it with it, your money's gone. If you do self-custody of crypto, which means you are the ones keeping track of your private keys. If you lose your private key, your crypto is gone. If your private key gets hacked because you expose it somehow, your crypto is gone because somebody else will spend it for you. So these are the two options. And just like people do with cash, you want some balance, right? I mean, you do want to have some cash that you can spend easily and readily. And you probably want to have that in your wallet and some of it at home. And if you think we're heading into a pandemic or into social unrest, you might want to keep more cash at home. And in more normal circumstances, you might want to keep more with a custodian. And the same is true for crypto. There's nothing fundamentally new here, but the expressions tend to be somewhat different from what you might be used to. Okay, which token should you own? Now, let me have this very, very large disclaimer here. I'm not trying to provide investment advice. So you shouldn't go home and say, well, Albert said you should definitely buy Polygon, for example. So this is not to be construed as investment advice. This is just trying to explain the universe of things that you can own. And throughout this, I've been mentioning Bitcoin because it's been around the longest. And I do suggest that anybody who holds crypto should hold some amount of Bitcoin. Now, I'm putting BTC there. That is essentially the quote unquote ticker symbol. And I'm doing that because there are other things that have Bitcoin in their name. So the thing, if you want to own Bitcoin, the thing you want to own is BTC. And similar, Ethereum, which is sort of the longest running of the super programmable, the ones that have the most expressive smart contracts, you want to own ETH, which is that thing. And there are other things that will have Ethereum in the name, but they're not ETH. After those two, again, those have been around the longest, they have the most usage. There's a lot of other things out there in that world. And I've listed some things. There's so-called layer ones, they're layer twos, they're privacy coins that are non-traceable, they're applications, they're NFTs and DAOs, and I'll have slides on these. On all of those things, remember what I said, the famous Peter Lynch quote, you want to know what you own and you want to know why you own it. So all of these things, if you want to, once you've sort of gotten going with it, if you become excited on the basis of this presentation and you want to learn more, you need to do your own homework and you need to develop your own theory as to why you would want to own one of these. Now, there's a whole group of coins known as meme coins. And the best known one of these is Dogecoin, but there's Shiba Inu and there's a myriad of others. There's a few things that I want to point out about these. The first thing I want to point out is that not all meme coins are created equal. So Dogecoin, for example, is a fork of Bitcoin. And the security of some of these meme coins as a result is highly questionable because the security of a blockchain depends on how many miners there are and how decentralized mining is. And for some of these meme coins, mining is extremely centralized. There are others that are built on Ethereum and they inherit Ethereum security, although of course their own smart contracts might have problems. Now, the second important thing is they are meme coins, and like memes, they come and go. And there are certain memes that are super widely used for a while and then they disappear almost entirely or entirely. And the same is true here. So the only way to make money in this is if you happen to be early and you happen to get out before the meme runs out. I personally have never held any of these, and my general recommendation is to avoid these for all the reasons I just described. But they do exist, and they are a part of crypto culture, so you will definitely run across them. Before explaining some of the other remaining terms, I want to talk a little bit about alternatives to holding crypto directly. There are other financial products that give you exposure to crypto, but they look totally like a traditional financial product. So there's a company called Grayscale that has so-called Grayscale Trust, like the Bitcoin Trust, the Ethereum Trust. These have fairly high administrative fees, and they also may depart from net asset value, meaning sometimes the trust units are worth more, sometimes they're worth less than the underlying asset. There's now finally, after a very long time, there's an actual Bitcoin ETF. So you can just, if you have a 401k account, you can buy it like you can buy any other ETF in your 401k account. There's also a very modern asset manager called Titan. It's essentially an app on your phone, and they manage money for you. They have a crypto strategy. There's a company called Otis, where Union Square Ventures, where we are investors. They let you buy, for example, fractional NFTs, where you might buy a very small portion of an NFT. So, and again, it's totally non-crypto. You just like any other broker on any of these, you buy them either in your brokerage account or you send them money, they buy and hold the crypto for you. we're getting almost near the end here, but I wanted to explain a few more terms that you will run across. The first term is NFTs. Now, Bitcoin, Ethereum, the things I've mentioned so far, there are many, many tokens of exactly the same type. So if I send somebody 0.5 Bitcoin and they send me another 0.5 Bitcoin, I'm back exactly where I was. They're completely fungible, substitutable for each other. NFTs, on the other hand, are non-fungible. Many times there's a single one of them, or there's a very small number of them. And it's like, you know, it's like a Manet painting versus a Monet painting, or a Warhol. And even within Warhol, of course, not all Warhols are the same, and they're not substitutable for each other. So non-fungible tokens tend to represent things, or tend to be things like digital art that cannot be substituted for each other. The NFT on the right is from a series of NFTs called CryptoPunks. This particular one sold at Sotheby's for $11 million. There was a huge bubble in NFTs. But again, NFTs aren't some completely crazy, wacky, vapid idea. What it is a way in the digital realm of separating the item, which is this image, which I copied. I have a copy of this image. You can make a copy of this image. But there's only one person who has the bragging rights, so to speak, to this image, right? Because they're the only ones who can prove digitally on the blockchain that they basically could sort of change what's in this so to think original pixels, if you want. So this is really kind of in a way, a very pure form of the ownership of digital assets, where it's just about the bragging rights, but everybody itself can copy the underlying asset. And what's interesting about these is that if you think about classical art, many artists sold their paintings for $100, $1,000, whatever, paintings that subsequently got sold at auction for 10,000, 100,000, millions of dollars. And the artists never saw anything of those subsequent sales. Because of the way these NFTs work, not all of them, but some of them, they're structured in a way where when you transfer ownership to somebody else for more money, a fraction of that additional sale actually goes back to the original artist. So they're really interesting innovations here that play with the digital ecosystem in ways that weren't previously possible. And so, much like I said earlier, these are real innovations. That doesn't mean you can't have a bubble. You can have a real innovation and you can also have a bubble. And I think without a doubt, many of these NFTs will be found not to sell ever again for the values that they've already sold, but some of them will. And by the way, not that different from a lot of art in general. Another word you may run across are DAOs. So DAOs are decentralized autonomous organizations. And you can think of them like clubs. They're clubs or co-ops just on the internet. And they tend to have extensive discussions, usually on something like Discord, and then tend to make their decisions via having discussions and then voting. Now, in order to vote in these decisions of a DAO, you need to own what's called a governance token. And sometimes if you have more tokens, you get more votes, and others, it's just if you own any number of tokens, you get a vote. And these DAOs are springing up for all sorts of things. Just to give some examples, the DAOs that control protocols, like the Uniswap protocol, which is a kind of decentralized exchange, is controlled by a DAO, and the members of the DAO discuss how the protocol should evolve. There are NFT collector DAOs. So, you know, if you're like, hey, I don't have enough money to own any of these NFTs outright, but I do want to be part, you can join a collective where the collective decides which assets to buy and also which assets to sell. Many of these DAOs, by the way, are pseudonymous, meaning people meet up on the internet under pseudonyms so that you don't necessarily know who you're dealing with. But because these tokens are involved, there's sort of a sense of community. And again, they're springing up for weird things. People may have heard of the Constitution DAO. There's a bunch of people who came together on the internet to try and buy the original of the Constitution that was sold at auction. Unfortunately, they got outbid. But there are other weird DAOs. There's one called Vita, for instance, that sponsors longevity research. And there's many of them. And it's kind of a fascinating world because it is clubs on the internet that have a native way of voting built into them, and that native way happens through cryptocurrency. Final concept that you may run across is the concept of yield. I consider this to be more of an advanced concept, but in certain instances, when you have a type of token, you can do things with that token. You can stake it, lock it, lend it. And when you take that action, you get some yield, meaning you get paid additional tokens. Sometimes you get paid in the same token, sometimes you get paid in a different token. And of course, there's no free lunch, right? So generally, you're getting this yield because you're taking some degree of risk. And the risk might be that you lose your tokens outright, or that you sell your tokens at the wrong price, that you could have gotten a higher price if you had done it differently. So you're taking some risk and you're being rewarded for that risk. And so you may, as you start to research this, you may learn about yield in crypto. And that can be relatively high yield. Why? Because there's also a lot of risk. This is still a very early nascent area. Unlike other areas that are well established for hundreds of years, this is around for a decade plus. And so it's not unusual to find much higher yields than you could find elsewhere. They are commensurate with much higher risk. Okay, I want to address one question which gets bandied around a lot, which is the idea that crypto is a terrible, horrible thing for the environment. And I want to immediately distinguish between two things. There are different consensus algorithms. I earlier described the outline of the consensus algorithm for Bitcoin. That's called a proof of work algorithm because you're proving that you've done the work to solve the puzzle. But there are many chains that run on a proof of stake algorithm. And by the way, Ethereum, which currently runs a proof of work, is in the process of migrating to proof of stake. Now, proof of stake in a decentralized world, it's not as efficient as PayPal running the centralized database. But the overhead relative to the centralized case is relatively small. It's not crazy overhead. So then that brings us back to the proof of work. So in a few years from now, Bitcoin will be the only real proof of work system left of any scale. And so then the question is, well, isn't that really terrible for the environment? And right now there's this fight in upstate New York about a coal-fired power plant that people seem to be wanting to use for Bitcoin mining. And so the key thing to point out is the key input to Bitcoin mining is electricity. And so if people are going to use a fossil fuel power plant, what that shows is the abject failure of Andrew Cuomo's energy policy, where in the state of New York, you can still run a coal-fired power plant and make cheap electricity. That should simply not be possible for any use case, whether it's Bitcoin mining or aluminum smeltering, which is also a super electricity intensive process, right? So number one is we need to make sure we live in a world where fossil fuel energy is super expensive. If you look at Texas, for example, Texas has tons and tons of wind and solar assets. And a lot of Bitcoin mining has moved to Texas because in Texas, the electricity price at times goes negative. That's when there's too much solar output or too much wind output. And now you can get paid to mine crypto. So generally speaking, the first realization is we have to make fossil fuels expensive no matter what. And that's completely independent of Bitcoin mining. But the second thing is there are many really interesting initiatives underway to use Bitcoin mining to actually deploy renewable assets. And just to get a sense of how this works is, if I want to build a community solar array today in my community, I need to go around and I need to sign up people. And I need to go to people and say, look, we want to build this community solar array. And please sign up for the electricity. And by the way, it's going to be available in a year or 2 years from now. And that's a tough sell. I mean, people are like, you're asking me to sign up for something today that you haven't built yet, and you're going to build it in a year from now? Like, why don't you come back to me when you've built it? So what's happening in a bunch of places around the world now is that people are building solar arrays, they're using them for Bitcoin mining, and then they're going to sign up customers. And now you can go to a customer and say, there's a solar array, it's already built, you sign up today, I will turn you on today. So that sort of criticism of Bitcoin's electricity footprint is valid at some level, which is, yes, it consumes a lot of electricity, but it's not valid at the, well, this means that it's basically completely aggravating the climate crisis in some like immeasurable, unredeemable, unredoable way. I think first we got to lead with the right energy policy. Second, we can use this to bootstrap new renewable assets. So I think it's important to recognize that, yes, there are bad things happening. There are places in the world where people are using fossil fuels to mine Bitcoin, and that's a terrible no-go thing. But that's first and foremost a failure policy and not so much a criticism of Bitcoin itself. Okay, some final thoughts. All of this is just supposed to give you the understanding so that you, when you start to do your own homework, have enough background. It's also aimed at giving you enough understanding that there is truly an innovation here, that that isn't, you know, some sort of completely made up thing that has no use and that doesn't serve a purpose in the world. This does serve an important purpose in the world. This is an important innovation. Second, final thought is don't engage in frequent trading. You will owe a lot of taxes. By the way, not dissimilar from what we talked about when we talked about stocks and equities. If you trade a lot, if you go in and out, each time you sell something that's appreciated, you owe taxes. In crypto, it's a little worse in the sense that the infrastructure isn't really set up yet to tell you. Your brokerage firm won't tell you. You need to keep track of it for yourself. So definitely do whatever you do, don't do a lot of trading. And then also don't ever get caught up in hype. At the moment, I'm so glad we're giving this presentation now when crypto has come down a lot, because it feels like people are sort of like, oh, well, I'm not going to invest just out of hype. But we may enter and out of the upcycle. And when we do, don't get caught in the hype. Just pace yourself. As with all investing, you want to pace yourself. And as I've mentioned several times, be careful about security. Just like you are pretty good with trying to protect your bank password or maybe your email password because you don't want people impersonating you. You really got to be careful here, because especially when you self-custody, if somebody gets access to your private keys, they will take your coins away from you. That's it, and we'll go to questions and answers, and I'm going to stop sharing so I can actually see everybody.
Albert, I have a question. So when it comes to a lot of industries that are barely entering Web 2, or they're starting that phase, do you feel like they can skip that and go straight into Web 3?
Yeah, so let me maybe first clarify some terminologies. I've used the word crypto throughout because I think from an investing perspective, that's maybe still the right way to think about it. But a lot of people have started to use the word Web 3. And so the sort of idea is that Web 1 was kind of just about publishing. You put up websites. Web 2 was this web where we could read and write, but it was mediated by these large companies like Facebook and so forth. And Web 3 is where we can read and write, but it's not mediated by a company. Instead, it's mediated by a protocol. And I definitely think that leapfrogging is possible. So I think industries that don't have a huge amount of Web 2 solutions, they might find that there's a Web 3 solution that works for them, so they don't need to make somebody the king in the meantime.
I have a question, Albert. Thank you so much for this talk. I just wanted to ask a question. You gave a bunch of examples of very exciting projects in this space, and I'm curious. Part of I think some people's hesitation, mine included, is like it doesn't seem like, well, there's a bunch of exciting projects. There's nothing broad that like a lot of people are using, and so it seems in terms of actual use cases. And I'm wondering, and so then it kind of seems like, well, but it's been around for so long. Why is that? Could you speak to that a little bit?
Yeah, it's a fantastic question. So I think that people like to hate Microsoft, and Microsoft definitely basically buried Netscape. I mean, they made no qualms about it. There was the infamous like, let's cut off their air supply memo. And what was it that they were actually talking about? Well, in the early days of the web, there was this conundrum where people wanted to be on the web, but in order to be on the web, you had to have a web browser. But where did the web browser come from? And so like, I'm old enough to remember when AOL mailed out like tons of CDs. I mean, they just mailed out cajillions of CDs, and people would insert a CD, and that's how they wound up with a web browser. It also, of course, pointed them first and foremost at AOL's walled garden, but never mind. But Netscape had this problem, like how were they going to reach people? But Microsoft didn't have that problem. And Microsoft put Internet Explorer onto every Windows machine. And so everybody suddenly had access to the web. And that moment really, in a way, hasn't happened yet for crypto. Like your phone doesn't come, it comes with a regular wallet, like it comes with Google Pay or Apple Pay, and you can put a credit card in, but neither Google Pay nor Apple Pay support crypto yet. So we're still at that much earlier moment in the web when relatively few people had the web. When it comes to Web3, we're still at that moment where relatively few people have crypto wallets compared to how many people have a web browser. So I think this inflection point is actually still ahead of us. The inflection point where it's as common to have a crypto wallet and a powerful crypto wallet as it is today to have a web browser. And you have a web browser on your laptop and on your phone. And we're not there yet. And so we are even though it's been around longer, like the Internet Explorer, if you looked at my timeline, Tim Berners-Lee had 90, 92 was HTTP, 95 was Internet Explorer. So there was only like a 5-year span, and we're sort of 10 plus years into this. But one of the reasons is that the incumbents have a lot to lose here. And so it's not in the incumbents' interest to spread this technology widely, right? And at the time, Microsoft spread it widely because it thought that it was under attack by Netscape. And so Microsoft was like, we're going to lean into this and we're going to cut them off. But in a way, what Microsoft did is, in a weird way, is it really enabled the internet. And much as people like to hate on Internet Explorer, but there's a chart that I sometimes show that shows web usage and Internet Explorer, and they basically correlate 100%. And the big jump comes with the release of Internet Explorer. So this moment doesn't exist yet. And Apple has been very anti-crypto, largely because they love their 30% cut in the App Store. And they realize that if crypto is widely deployed, that 30% cut in the App Store is going to go to zero because the payment rails will be built into the apps themselves. So, and Google is less clear why Google hasn't leaned into it. But I do think that's the missing inflection point.
Hey, Albert, can I ask your
Please.
opinion on something?
Sure.
I've been dabbling in crypto for about 4 years now, and I agree with what you said about like we're not even close to like the adoption phases of it yet. I was just wondering, what's your thoughts on the current SEC Ripple lawsuit?
Yeah, I mean, so just to give people some background, so many crypto projects for a while raised money by selling cryptocurrency to people. And people buy the cryptocurrency and give money to the issuing company. And in a number of cases, the SEC has said, well, that was an unregistered securities offering because your cryptocurrency is really a security. And there is a rather abstruse test for determining whether something is a security or not. It's called the Howey test. The Howey test is really old. It goes back to, this is kind of a fun little anecdote. There was an orange grove in Florida, and the orange grove was having trouble making money selling oranges, but they had a whole bunch of tourists. And so what they sold tourists is basically they said, look, you basically will buy this set of trees from us. And when we sell the oranges, we will send you the money from the sale of these oranges. And later on, those scripts that they basically sold people that entitled people to a set of orange trees were deemed to be securities. And so this is from the 1930s, basically. And so the SEC is going around is applying this Howey test, which has several prongs that I don't want to get into, to these crypto projects. And so a lot of that stuff is in litigation, and I really don't know how it's going to turn out, to be honest, because these are, I think there are good arguments on both the government side, on the SEC side, and the good arguments on the crypto project side. And by the way, many of these projects have some, let's say, run-in with the SEC. In fact, it's easier to count the projects that don't have some kind of current SEC investigation of some type than it's to count the ones that do have one. Now, just to be clear, the SEC's mission as an agency is twofold, and it puts the SEC in a slightly tricky position. It is, one, to protect investors, but two, it's actually to help with capital formation. And so depending on who you talk to, even within the SEC, there are people who are like, no, we should be encouraging this. And then there are other people like, no, this is really bad. It's going to get a lot of investors burned. All of this is a long way of answering a question, which is, I don't really know where any of these lawsuits are going to come out at the end of the day.
Hey, Albert, I got a quick question for you. Thanks for the presentation, by the way. There's seemingly increased evidence that crypto is more highly correlated to equity markets than previously anticipated. Do you ascribe to that hypothesis, and does that make it less attractive or meaningful to you in any way?
Yeah, so let me explain the question first. So when people talk about, like, ideally in your portfolio, you have assets that are not all that correlated, right? So if one thing goes up, maybe the other thing goes down, but if this thing goes down, something else goes up. And so your portfolio kind of doesn't, as a whole, fluctuate as much, right? This is the idea behind diversification, is that your overall fluctuation is diminished because, okay, correlation among different financial assets has been increasing for many, many years across the board, across countries, across assets, and so forth. And that has a lot to do with the fact that we have a lot of algorithmic trading, and that computers are making buying and selling decisions. And crypto is no exception to this. And there's a lot of financial capital in the world that moves around very, very rapidly. And so I am not that surprised to find high correlation, including for crypto. So the way I think about this personally is just, it goes back to being anti-fragile in your investing. So, you know, you need to have lots of different bets, and even if they are correlated at times, hopefully, you know, if in the extreme cases where some things go to zero, you have things that don't go to zero, right? And so while increased correlation is painful, and it means our portfolios, even diversified portfolios, tend to be more volatile than they used to be, you know, I don't think this is any reason not to own crypto. I believe that crypto assets, some of them anyhow, not all of them, some of them will go to zero and some of them will appreciate over longer periods of time with a lot of volatility. And the fact that this volatility is somewhat coupled to the stock market is unfortunately unavoidable in the way today's financial markets work.
Thank you.
Hey there. Hi, everyone. Hi, Albert. Thanks for guiding all of us through this. I'm wondering, I've been very curious about making some NFTs with a group of artists, and I'm wondering if you could direct me towards some good resources to do some more research.
Yeah. Instead of guiding you towards resources, let me maybe explain some of the questions you want to answer, right? Mm-hmm. So I think the questions you want to answer are, first of all, is this going to be physical art that's represented digitally, or is it going to be digital art? That's one of the first questions. The second question is, when you have digital art, where do you actually store that digital art? So a lot of the early NFTs, the digital art is just stored on some random server. And I think that's basically not how it's going to be in the future. In the future, I think the most successful NFTs, the actual file will be stored on chain. And there are chains that specialize in this, such as Arweave, for example. Again, disclosure, at say Union Square Ventures, we have exposure to Arweave. So, so that's a question you want to look into. Like, what is it that we are actually this NFT? And if it's digital art, whether it's digital music or digital imagery or digital video, I believe the digital asset itself should live on a chain. And then the next thing you want to think about is, where are you minting, on what chain are you minting the NFT token? So that's separate from the digital asset. So you can store the digital asset on Arweave, but you can mint the token. And you want to think about, like, you know, how much of a fee do we have when we mint the token? Do we have a low fee? Some systems have very low fees, some systems have very high fees. And then you also want to think about, do we want to be able to participate in future sales? And there are systems like Zora, for example, that make it very easy to set it up so that you can participate in future sales. And so I guess what I think, if I were advising artists today, is to A, pick digitally native art, to B, store that art on chain, and to C, issue in a relatively low cost environment, but with a smart contract where you get some of the proceeds of future subsequent sales of this NFT, so that you don't just get the money when the NFT is sold the first time, but if it turns out that your art has persistent appreciating value and it gets transferred again and again, you get a cut of those future sales. And that is entirely possible today. So those are the items I would research. In terms of overall research, Andreessen Horowitz has actually put out repeatedly very good compendia of what to read on crypto. And that's a pretty good resource library. But I will think of some other resource libraries and send them around to people who have signed up for this.
Awesome. Thank you.
I think we're at the hour, so we'll let people go. These were good questions, and you know, this won't be the last of these seminars. So if you have other questions, just send them to us, and we'll try to address them in future installments.
Will this recording be available anywhere?
Yes, it will be. Shanika, go ahead.
Yeah. So yeah, we're recording it, and we'll be uploading it to YouTube as soon as possible, and then I will send out a link to everyone who was participating today, and then you can send it out to your friends and family or whoever else you think that will benefit from it. So majority of our programming like this, we try to have the information on YouTube, so it's really accessible for people to like go back, and it's just evergreenly living there. Actually, that reminds me, if you're interested also in continuing conversations around like the history of money, we actually had a 4-part series last year with a Hudson-based investor, Kianga Davernton, and it was super interesting. And you know, she really goes into like detail about like currency and the history of volatile currency, and like how like crypto plays a role in that, but also just what's going on with our idea of like the US currency, you know. And anyway, I'm dropping the link in the everyone chat, and so if you are interested in that, please check out those videos. And yeah, you'll be hearing from us via email. If you have to sign up for the 1/8 of an eighth thingy of Bitcoin, or,
Yes.
or
Some tiny amount of Bitcoin. Yes.
I processed the information. I'm just gonna need like 3 days to really understand it. I got it. But if you please fill out the Google form, and we'll be following up with you. And thank you so much, Albert. Again, I really do think that it's so special.
So much fun. My pleasure.
You know, host your expertise here and have it be so accessible to everyone. And so, yeah, look forward to another edition of this and more programming, and have a good night, everyone.
Good night.
Good night.